Hey everyone, welcome back to the channel. With recent news about banks collapsing and financial instability on the rise, you might be wondering, what's going on? And more importantly, how can I protect my money? In today's video, we're diving deep into why banks are collapsing, what it means for you, and most importantly, how you can secure your finances before it's too late. Make sure to stick around till the end for crucial tips that could save your savings. 1. Why are banks collapsing? The shocking truth. In recent months, we've witnessed the collapse of several large financial institutions, and this could just be the tip of the iceberg. But why is this happening? And what does it mean for the average person? Banks, which are typically seen as secure and stable institutions, can fail for a number of reasons, and understanding these reasons is crucial to recognizing the potential risks involved. One of the primary reasons banks collapse is poor risk management. Financial institutions take on risk when they make loans, invest in assets, and handle customer deposits. When a bank miscalculates the risks involved, such as by overextending credit or failing to account for the possibility of defaults, it can quickly find itself in financial trouble. Poorly managed risks can leave banks vulnerable to financial shocks, and when the risks don't pay off, banks can lose substantial amounts of money. Another major factor contributing to bank collapses is liquidity crisis. This occurs when a bank does not have enough liquid assets, like cash, on hand to meet its short-term obligations. Banks rely on being able to borrow from other financial institutions or raise funds quickly to maintain operations. However, if the financial system itself becomes unstable, or if other banks are also struggling, liquidity problems can escalate. When liquidity dries up, the bank may be forced to close its doors or be taken over by government regulators. Exposure to bad debt is another common reason for bank failures. Many banks extend loans to borrowers, but not all borrowers are able to repay. When the economy takes a downturn, or when interest rates rise, more people and businesses default on their loans. If a bank has too many of these bad debts on its books, it can end up losing a significant portion of its capital. If a bank can't recover from these losses, it may be forced to shut down. Speaking of rising inflation and interest rates, these economic factors are also playing a major role in bank instability. Inflation leads to increased costs for goods and services, which can hurt consumers and businesses alike. Higher interest rates, often set by central banks to control inflation, can increase the cost of borrowing, making it harder for individuals and companies to repay loans. This creates a ripple effect, leading to more defaults, strained businesses, and ultimately, greater pressure on banks. As more banks face these challenges, a wave of bank collapses could become a real possibility. Lastly, the global economy's instability also plays a role. Global supply chain disruptions, trade wars, and political instability all contribute to an unpredictable financial environment. When there's uncertainty in the global markets, banks become more hesitant to lend, and credit becomes tighter. With fewer investments and higher levels of financial stress, large banks can struggle to maintain solvency, leading to their downfall. 2. How a bank collapse can impact your money. When a bank collapses, the impact is far-reaching, and it can affect your personal finances in several significant ways. One of the most immediate consequences is the disruption to your access to funds. Imagine waking up one day and being unable to withdraw money from your bank account or make transactions. That's a reality many people face when a bank goes under, especially if the collapse happens suddenly. If your bank is experiencing a crisis, it could take days, weeks, or even longer to regain access to your funds, leaving you in a vulnerable position. Now, savings and investments could also be at risk. While deposit insurance, like FDIC insurance in the US, protects up to a certain limit, anything beyond that limit may not be guaranteed. For example, if you have a significant amount of money saved over the insured threshold and the bank fails, you could lose part or all of that excess amount. That's a serious risk for those with large deposits or investments in vulnerable banks. But the consequences of a bank collapse go beyond just individual accounts. The ripple effect of a failing financial institution can lead to widespread economic impacts. For instance, job losses are a real possibility, as companies and businesses that rely on credit and loans from banks could suddenly find themselves without the necessary resources to operate. This could lead to layoffs, hiring freezes, or even bankruptcies. 3. Steps you could take to protect your savings. First, it's crucial to make sure your money is within the deposit insurance limits set by your country's regulations. For instance, in the U.S., the Federal Deposit Insurance Corporation, FDIC, insures up to $250,000 per depositor at each insured bank. This means that if the bank were to fail, you would be protected for the first $250,000 of your deposit. If you have more than this amount at a single bank, you might want to consider spreading it out to ensure full coverage. Second, diversification is key. The old saying, "Don't put all your eggs in one basket," is especially true when it comes to protecting your wealth. Instead of keeping all your money in one bank account or one type of investment, consider spreading your savings across multiple accounts, different financial institutions, and various asset types. You might look into things like stocks, bonds, real estate, or even precious metals like gold, which can serve as a safe haven in times of economic uncertainty. Finally, it's important to stay vigilant about the financial health of the institution where you keep your money. Regularly check your bank's financial reports and keep an eye out for any warning signs or red flags that could indicate financial trouble. This could include things like sudden changes in management, significant losses, or any news about regulatory issues. Being proactive about this can help you make timely decisions about your finances and avoid major losses down the line. 4. Is your bank safe? Warning signs to watch for. How can you tell if your bank is safe? There are several key warning signs that you should be aware of. First, check the bank's financial history. If your bank has a record of questionable financial practices, such as taking on excessive debt or making risky bad investments, this could be a sign of trouble ahead. These practices can weaken the bank's stability and could affect your deposits. Next, monitor the bank's credit ratings. Credit rating agencies assess a bank's ability to meet its financial obligations, and if their ratings begin to decline, it may signal underlying financial issues. A falling credit rating could be an indication that the bank is facing difficulties or is at a higher risk of default. Another warning sign to watch out for is a sudden increase in fees or changes in terms of service. If your bank unexpectedly raises fees or changes the terms of your account, it might be a sign that they're struggling financially and trying to generate more revenue to stay afloat. Lastly, take note of any significant reductions in services or staff cuts. If your bank starts eliminating branches, reducing customer service hours, or laying off employees, it could be a sign that they're trying to cut costs due to financial stress. Being proactive and watching out for these red flags can help you make better decisions about where to keep your money and whether it's time to move your assets to a safer institution. It's always better to take action early than to wait until problems escalate. 5. The future of banking. What you need to know now. What's in store for the future of banking? With everything constantly evolving, predicting the exact future can be tricky. But one thing is certain: change is on the horizon. The financial landscape is undergoing a significant shift, with more people turning to digital banks, cryptocurrencies, and decentralized finance, DeFi, systems as alternatives to traditional banking. These new options offer faster, more flexible ways to manage money and could play a huge role in how we bank in the coming years. While traditional banks might still feel like a secure option for many, the rise of digital banking and decentralized finance is undeniable. People are seeking more control over their financial decisions, and these newer banking methods cater to that demand. Digital banks, for example, often offer lower fees and a more streamlined, tech-driven experience. Cryptocurrencies and DeFi systems, on the other hand, bring new possibilities, like peer-to-peer transactions, borderless payments, and decentralization, where no central authority controls your assets. So, what do you think? Are you worried about your bank's safety, or do you feel secure? Drop your thoughts in the comments below, and don't forget to hit that like button if you found this video helpful. Make sure to subscribe for more updates on personal finance, banking, and how to keep your money safe. Thanks for watching, and stay financially savvy out there.